Okay, we have two charts here, how to trade the black charts. We have two trades on the black charts that we trade off of. We trade a number 1 and a number 3. A number 1 is a deep retracement to market profile, or what I call the hedge, which is a red dashed line to sell, a green dashed line to buy. So we have two market profile charts that we trade off of. One will be in the bottom left-hand corner, which is more volume-based. One on the right-hand side, which is more price-based. Very simple methodology. Okay, at 8:30 this morning, I said we have a potential number 1 right at 52. I said we have 5 times confluence at 52. The reason I picked that exact level was because of these two charts. I seen I had the hedge right at 52. Look on the right side of your margin, 52. I seen we had volume profile right below 52. Okay, and then also on J signal on our own Ninja charts, we had 52 also, just below it. And then we had symmetry dots, and then we had our own market profile on our own Ninja chart. So we had 5 times confluence. The bottom line, here's how you trade it. You want to, when you're trading number 1 trades, okay, when you're trading number 1 trades like this, you must first, when you first log in, if you're going to trade the black charts, there's no counter trend trading off the black charts. 0. You do not counter trend trade off the black charts. If the trend on these moving averages are down, if the trend is down, you can only sell the red. Sell red hedge or sell red HVA. Vice versa, if the trend is up, you can only buy green or buy green hedge. That's it. So there's only two options. You're going to sell, right, if the moving averages are down in a downtrend, or you're going to buy green if it's in an uptrend. And the best way to do it is on the first test. That's the best way to trade this, on the first test. So at 8:30 this morning, okay, we were down here at 51.60, and I said, let's sell 52. That's the area to sell. And the reason I said it, I had high value here, right at just below 52, and I had the hedge just at 52 on the price profile. That tells me I have confluence. You don't need confluence, but the more stacked areas you get, the more accurate the market profile will be. Now, this same setup has worked for 30 years, since 1985, same exact setup, moving averages in a downtrend, sell the first test of high value area. Moving averages in an uptrend, buy the first test of low value area. The difference between what we show and what a lot of traders show out there, or educators show, our market profiles calculated a little bit different. So it's trading with order flow. A lot of traders trade off the previous day's market profile, the control point, which we don't use. Very inaccurate. If you trade off yesterday's previous high, previous low market profile, meaning the high value, low value, very inaccurate at times. So I like to know in the order flow, as it flows, where my support and resistance is. That's why these are very accurate. So the best way to do it, if the moving averages are down, sell the first test of high value that you've run into. Now, there's going to be two charts to trade off of here, right, to look off of. If I got high value here at 52 and I had high value here at 52.30, which one do you sell? Well, the first one that it hits if you get a pull-in bar off my Renko bar. Now, if I had 52 here, but over here on my price profile, instead of 52.30, I had 52.05, then I would wait till 52.05 to look for a pull-in bar within 2 ticks. In other words, if they're close together within 10 ticks, you take the outer edge one to reduce risk. If not, you take the first one you come to on the first test. That's the best way to trade these black charts. Okay? So as you can see, my level that I called out at 8:30, at 9:30, an hour later, this is a very leading indicator. Market profile is leading. It's the only methodology I know that leads the market, doesn't lag the market. You're not trading off moving averages. You're not trading off the MAC, which is very lagging. All this other ridiculous indicators that are very lagging. We're trading off order flow. We knew 52 was resistance, and look how crude oil reacted off of 52. Now, how do we pull ourselves in? When you get within 2 ticks, maximum 3 ticks of your level, you're going to use what's called a pull-in bar. I'll pull this up. So as we moved up into the 52 area, we do not concentrate on the green or red bars. We concentrate on a doji or spinning top. The spinning tops will be in blue. The dojis will look like plus signs like this. So what I want to do on a number 1 is I want to look when I come within 2 ticks of these levels. I'm going to concentrate on my Renko bar in my own Ninja chart. I want to wait for the first spinning top, which are in blue, or a doji, which is a plus sign. Once that forms within 2 ticks, maximum 3 ticks, I'm going to draw a line underneath that spinning top or doji. That will be my pull-in bar. Wicks do not count. Okay? Wicks do not count. This is not a pull-in bar. Wicks are for amateur traders. A lot of traders don't understand that. Wicks are where the professionals take amateur traders' money. The wick doesn't count here. Didn't close below it. Didn't close below it. There's the body of the candle close. Here's where you want to get short the market. This is the exact bar entry that you want to get short exactly right there. The exact bar. Open it up on the next one when it closes below it. It's got to be the body of the candle. Typically it happens on the next bar. This one oscillated a little bit and then it finally broke down. You want to use the highest wick, the highest bar, the highest high to trade off with your pull-in bar if you're shorting. This is the highest bar of all these bars. So leave it static. If this next bar went higher, then I would have pulled this in and pulled my pull-in bar at this spinning top low. If this would have been higher than this. So you use the highest high bar for your pull-in bar. Okay? Your maximum stop is going to be 15 ticks. Look at the reaction I got off my number 1. And this is called all the way back here at 8:30. This is projected right here at 8:30, right here, to sell this high. Look how accurate market profile can be when you're way away from it. That's just knowing price action, how market profile works. Okay? So that was projected all the way here. Make sure you get a pull-in bar to pull yourself in the trade. So the methodology is this. If you go to the bottom right under documents, you can print this out knowing how to do this. When you log into Omnivia and you view my screens, go to the bottom right under documents. You'll see how to trade the black charts. It says exactly this. Find the trend first. There's your longer term moving average pointed down, shorter term cross down. Sell the first test of HVA. Once you get up into it within 2 ticks, make sure you look for a doji or spinning top blue, doji plus sign. And then you're going to get a pull-in bar, which is the body of the candle close. The body of it, not the wicks, the body of the candle to pull you in. Do not risk more than 15 ticks on my black charts. They're extremely accurate. Okay, the same set that's been working for 30 years. They're extremely accurate. You do not need more than a 15-tick stop. Most traders use a 13-tick stop. So you get a $130 maximum risk for a nice little move down from around 95 all the way down below 60 on that nice number 1 sell. Okay? So that's how we trade it. Number 1s will always be against J signal. J signal, I have a number 3 only. J signal, this is a corrective wave up. Inside a profile, corrective wave up. The bottom line, J signal was in an uptrend. It doesn't matter on number 1s. J signal will always probably be optional number 1s because number 1s are catching the high, the swing high or swing low in the market. Where number 3 trades are higher lows or lower highs. As you can tell, this J signal was a higher low, and this J signal is a lower high. So right here. So J signal tries to catch lower highs or higher lows off breaking through market profile on the first break retest. So that's the difference between number 1s and number 3s. Number 3s are continuation trades. Number 1s trying to catch the V top or V bottom. Okay? Gerald, go to gold. Gold, same thing. I had 2 projected levels this morning on gold. At 8:30 this morning, we're sitting down at this level. 8:30 this morning, we were sitting down at this level. Here, I said we're looking to sell 44.5, and then 47 was way up here, another profile. Sure enough, we get into 44.5 an hour later. Same type of scenario. You're going to look for a pull-in bar. So let's see how she works. You look for a pull-in bar. Let's take a look at it. Use your 3-sim Renko to pull yourself in. Let me blow it up, make sure we understand it. Once you come within 2 ticks, maximum 3 ticks of the projected short profile, there it is. So as we moved up to 44.5, that's my projected short an hour earlier. Green bars are irrelevant. Wait till you get a spinning top, which is blue, or a doji, which is a plus sign. There's my spinning top. This is the highest high. I want to project once it prints within 2 ticks, maximum 3 ticks of that level. I want to put my bar below the low of that spinning top. Wicks don't count. The next bar at wick below, but that doesn't count. You need a body of the candle close below. Get this right below the bar. There we go. There we go. You can see the body of the candle close below. That is your short right there with a maximum of 13 to 15 tick stop. Okay? And obviously you've seen how that worked out also. We had a nice little trade. The projection was all the way down to 830 here. Hit my number 1, hit the top, and she crumbled to the downside. The bottom line is, go back to crude, Gerald. The bottom line, look at these setups. They're very, very productive when you look at this. Market profile is very, very productive. Now check this out. Look how these market profile accurate they are. Look how accurate they are. Now check out these swings. Look how accurate my market profile is. You just got to put it in relation to the methodology. High, low, low, and high. Now look at the last sell. Now what you want to do is, see the moving averages are down, right? So you don't buy this level, and you don't buy this level, but you sure as heck short this level. You see what I'm doing? What I'm doing, I'm taking the retracement trades at 830 I projected right here to sell this. Look at that move down from 52. We're down $600 per one contract with a maximum $130 and $150 risk on your runner. Selling the first test of high value area in a downtrend. We're not buying these. We're not counter trend traders. That's why Active Trader came out and said a lot of traders lose at what we do because they counter trend trade the market. They think they're smarter than the market. I'm not smarter than the market. You're not smarter than the market. We can't just, think that we can outdo the market. We can only let the market give us what it wants to give us. The best way to trade it with market profile, in my opinion, is looking for trend and taking the snapback trades into HV and LVA. Control point to me is irrelevant. A lot of traders trade control point. What I found, it's hit or miss. Sometimes it's good, sometimes it's bad. Why break even or lose money on trades? If we're going to put ourselves in high probability positions, we need to put it in at the HV and LVA with the overall trend snapback. It's the best way to do it. All right, so we nailed the high, projected an hour earlier, nailed the high in gold. That's how you do it. Gerald, go and check that off. You can review this video at daytradingthefutures.com. We do videos quite often, but that's how we do it, guys and gals. So see you tomorrow. Great run on crude. Good job on gold. See you tomorrow at 8:15. Everybody take care now. Bye-bye.